Well, thanks to all who are attending the webinar today. I am Krista Swanson for anyone who I haven't already had a chance to meet, and I am the lead economist for National Corn Growers Association. And one of the new things that I wanted to try here this year was a summary report at the end of each quarter to take a deeper dive into what the state of the corn economy is, and also offer a webinar to go along with that. So the content that I was planning to share today follows really closely with the report, and I will be sharing that report later today, along with the slides from this webinar this morning. So you can watch for that. For some of what's in the report won't be in the webinar, and vice versa. So that'll be something to read and reference as well. A few notes for how this will work is that I'm going to go through what I've prepared. If you have any questions while I'm talking, you're welcome to type those into the Q&A, and I can try to address those as they come up. And at the end, so everyone should be muted now automatically, but at the end, Jeremy's on, and he will be able to unmute if you raise your hand if you want to actually ask the question. Or again, you can always use the Q&A. So with that, I will get started. So one of the first things that I was going to talk about is the corn balance sheet. So the USDA just put out the April World Ag Supply and Demand Estimates, or WASDE report for short, earlier this week. And so just wanted to do a little bit of a recap on what that is telling us. So on the supply side, they lowered imports by 10 million bushels, but that wasn't really that big of a change. We'll look at that here in just a minute. But really, when we look at the 2022-23 marketing year, which is the 23-24 marketing year, is not in the WASDE report. The first time that'll be included will be next month. And that's sort of old news on the supply side. Production is what it is at this point for the 22 crop. And as we all know, corn production was down in 2022. A lot of the areas of the U.S. Had drought and lower yield. So as we look ahead to 23-24, even though that's not in the April WASDE report, I utilized some of the USDA's grain and oilseeds outlook to give us a bar on this chart for that as well. And we can see that looking ahead to next year, production is expected to be up almost 10% above last year. And if we hit these production levels that USDA is projecting, it would be the second highest production on record. And so that would be, definitely notable from a supply side. And coming into the 23-24 year, ending stocks for the 22-23 year expected to be a little bit lower. Therefore, beginning stocks for next marketing year would be down. But again, when we think about our corn supply, production makes up such a big majority of that. I got ahead of myself a little bit a few minutes ago when I was talking about the change on the supply side for imports. So I wanted to show that here. But basically, USDA lowered the import projection for the 22-23 marketing year from 50 down to 40 million bushels. And so therefore, total supply for that marketing year was reduced by the same amount. This was a little bit of a surprising change. We don't normally see many supply side changes for the marketing year at this point in the marketing year. But I also wanted to show, as we think about the outlook for 23-24, I mentioned USDA has the grain and oilseeds outlook that they put out in February. That's in the first column here. But in late March, they released the prospective plantings report, which, as everyone maybe already knows, changed expected planting acres from that earlier USDA number. And there is a little bit of a difference in how these two are calculated. The earlier number was more of a economic projection based on like what would be expected given supply and demand outlooks, and the prospective plantings is based on farmer surveys of what they say they're going to plant. So that second column utilizes that prospective planting intentions. And then I also threw up the Food and Ag Policy Research Institute at the University of Missouri just released their projections a few weeks ago, and they're also normally a very good source to consider. They are projecting planted acres a little bit higher even than planting intentions at 92.2 million acres, and a slightly higher area harvested, but they are projecting a little bit lower yield than USDA's 181.5. And we'll talk more about yield specifically here in a little bit, so I'm not going to go into that now. But I just wanted to show the three sets of comparisons for 23-24 outlook. I like to, at this early, looking ahead to next marketing year, I like to consider all the different reliable source projections that are out there. On the demand side, so the 22-23 demand was also low. And really the big struggle on the demand side has been exports in this marketing year. We'll look at that more in a second. But feed and ethanol, or food, alcohol, and industrial use, I should say, were relatively the same to down just a little bit. As we look ahead to next year, this is from the USDA Grain and Oilseeds Outlook from February. USDA is projecting that for next marketing year, we're going to see a 5% increase in total use. So that's excellent news, especially given the expected increases on the production side. So again, looking at that comparison, first recapping what USDA did in the April WASDE report earlier this week. So we already talked about the 10 million bushel reduction on imports. They actually also reduced food, seed, and industrial by 10 million bushels on the demand side. And notably, ethanol is about 75% of that use category, but that change did not come from within the ethanol portion. It came from the other part of food, seed, and industrial. That brought consumption down equally. And because we had the equal change on both sides of the balance sheet, ending stock projections did not change. I also wanted to show here, and I don't want to spend a lot of time on this, but just to have as a reference for you all, I included it here just because I want to get to some of the other topics. But I also threw up the USDA's original February outlook, kind of the update with some of the new information we have from USDA since then, and then also that FAPRI outlook. So FAPRI is expecting consumption to be a little bit higher, a little stronger than USDA, and then also production pretty much right in there with where USDA's updated outlook would be with those higher acreage. Alex, maybe I see we had a question come in. If you'd like to, I'm not sure I understand your question. So if you want to maybe reword that and type that again, I can try to address that. I'm going to keep moving on here, but the marketing year accumulated exports. So I mentioned that exports have really been our challenge on the demand side in the current marketing year. And this graph really shows why here. The dashed line represents last marketing year. The dotted line represents the 5-year average, and the solid line represents the current market year. And so what this is showing, the horizontal axis is weeks we are into the marketing year, and it's accumulated corn exports throughout this marketing year. And as you can see that we're really trailing behind both last year and that 5-year average quite significantly. So when we began this marketing year, USDA's original expectation for exports was really close to that 54.8 million metric ton 5-year average. And so currently the expectation is at 47 million metric tons, and this was in from the April World Ag Supply and Demand Report. So one thing I wanted to show that if we took that 5-year average trajectory for the rest of this marketing year and applied it to where we're at currently, it would have us coming out around 37.4 million metric tons. So you can see that if we had the 5-year pace for the rest of this marketing year, we would still fall quite short of where current export projections are. So a lot of the trade was expecting to maybe see that export number reduced a little bit. I will note that we have had really strong buys over the past few weeks from some nations coming in and buying. Really, China's gotten a lot of the attention in the past few weeks. But I will note that actually Japan, Guatemala, and Colombia and Mexico have all been bigger buyers since the beginning of March than China. So even though we've heard a lot about China, China got a lot of attention because they had several big single day purchases that again caught the attention of media and such. But as you can see here, really that China bar has been quite flat all the way back since about week 21, 22 of the marketing year. And so I want to note that what happened at that point, I should add, I threw up here, as you can see, the same current marketing year, 5-year average, and previous marketing year for Mexico and China. But China and Brazil began a new agreement where China is now importing corn from Brazil for the first time ever. The first shipment was made in November 2022. And, ever since that relationship initiated a few months ago, China has really turned to Brazil for a lot of their corn purchases. And that's why you can see here that, we have pretty flat movement in our exports to China since kind of corresponding with that time when they started getting imports from Brazil. So this is something important to watch. I think that USDA probably opted to not lower the export projection this month in hopes that maybe we continue to see some more quicker pace buying. Brazil won't begin their safrinha harvest until about June. So we do have a couple months here, and their supply is mostly depleted. So we are, kind of back to being the biggest supplier currently. And so there's a chance that we could see, some more rapid pace buying than that projected line there. Another big use category for us is feed. And, kind of the challenge there is just that production, the production challenges on the livestock side right now. This chart is taken from USDA, and it was made by them using the WASDE report estimates. But basically, turkey, broiler, and pork production are all expected to increase in 2023 as compared to 2022. So that's good news when we think about those livestock categories. Unfortunately, beef cattle inventories are at the lowest levels in decades, and beef production is expected to be lower in 2023. And because that's such a big component of total production, that it actually brings down the year-over-year change, even though we have the projected increase in the other use categories. And then thinking about where these things, I guess I didn't put a slide up about ethanol, but I guess just a quick note on that. We've seen gasoline consumption declining, both people not traveling as much even since COVID. A lot of that is maybe remote working and those types of things. Also, the growth in electric vehicles has challenged gasoline production, but I will say that it seems like there's some positive momentum on some policy initiatives that could help expand blend rates. And so as we think ahead to ethanol demand, hopefully that's a category that we can maintain the market share that we've had. When we look at what all this means in terms of ending stocks and stocks to use, those ending stocks and stocks to use were both pretty tight for the 2022-23 marketing year. And even though we don't have final numbers on that, that's getting pretty close to probably where we'll be. And then for 2023-24, those high production numbers, even though we see some increases on the demand side, the high production numbers are really offsetting that, and we see a little bit of a rise in ending stocks, but still relatively tight levels of ending stocks for next marketing year as well. Thinking about price trends, so the black bars here show the historical market year average prices since 2000, just for reference to see comparatively where we're at right now. The colored bars, there's a set of 3 of them for 2022-23 and a set of them for 23-24. And so the yellow bar is those USDA projections. The green bar represents FAPRI's projections, and then the blue bars represent May futures in the 22-23 category and December futures in the 23-24 category. And so for 22-23, I don't anticipate that we'll see this move much from where USDA has it pegged at 660. The market year average prices are based on weighting of when grain is actually moved. So at this point in the marketing year, a lot of that's already locked in. And to further support that, that May futures contract, yesterday's close was 656, and yesterday also the national average basis was about 10 cents above that. So it's definitely the current cash prices for that old crop are currently right in there around that marketing year average projected range. So again, I don't anticipate we see that change much, but looking ahead to price projections for 2023 crop, USDA has that pegged $1 lower than current marketing year at $5.60. FAPRI's projection is even lower at $5.32. And then I looked at what the December corn contract closed at yesterday, and it closed at $5.55. So again, thinking about prices that you can get for that grain, as it comes out of the field in next marketing year, they are right in line with where USDA has that projected. And of course, there's a lot of room for movement in that projection, a lot of dynamics that could influence that as we proceed with the crop this year and have the whole marketing year up in front of us still. I wanted to also touch on global production trends. The big news here is South America, really, and particularly Argentina's reduced crop. In the April WASDE report, USDA reduced the expected production for Argentina from 40 million metric tons down to 37 million metric tons. But this isn't as notable in terms of the global marketplace as we may think. Even though they're facing drought, and we're hearing a lot about that, Brazil is having what's likely a record crop. They're actually projected to produce 125 million metric tons, which would be well over the 116 million metric tons of last year. So essentially what's happening here is that although Argentina's production is strained, when we pool the two countries together, Brazil's production is mostly offsetting any declines in Argentina. And so together, those two nations are still producing a considerable share of world production at about 14.2%. And for reference, where US comes in terms of million metric tons, and this comparison, the US production is projected to equate to about a little over 30% of world production. So, but aside from production, the other thing that impacts us is, of course, what these two nations are doing in terms of exports. And so I wanted to share the US is projected currently to export 47 million metric tons, or 27% of world corn exports for this current marketing year. If we look back over the last 15-ish years, the U.S. market share used to be, even above 60%, well above 50% in several years, and has been trending downward over time as Brazil and Argentina have grown as exporters. Brazil's actually forecast to export 50 million metric tons, which would be larger than the US's exports. And so if that is realized, it would be the first time that Brazil corn exports would exceed US corn exports. So a lot of this has to do with Brazil expanding. They're expanding acreage, they're expanding in terms of yields, overall production is growing, and getting into new markets, like I mentioned with China earlier, is definitely a boost in terms of their exports. And then Argentina, even though production is challenged this year, they're still projected to be a pretty considerable world exporter as well. So now I want to turn attention to macroeconomics and outside markets and where things stand on that. So inflation, one measure of inflation is the consumer price index. And, I think we're all up on what's happening with that. As we look back over the last, mostly almost 40 years from the early 80s to 2019, average inflation was 2.7%. which is really close to the Fed's target rate of 2%. So that was really in a quite an ideal range over the last almost 4 decades. In 2020, due to COVID and the corresponding shutdowns, the U.S. Went through a really short but severe recession. At that time, we had inflation levels drop down to basically 0%. And then, from coming out of that recession up until the summer of 2022, inflation really spiked, grew really rapidly, and hit 9.1%, which was the highest level dating back to the 1981. And so the news from this month, just earlier this week, the new consumer price index was put out for March, and that was 5%. Notably, this was quite a significant change from 6% in February, but these are annualized changes. So this is looking at the change in consumer prices from March 22 to March 23, as compared to February 22 to February 23. So when we think about what happened at the end of February of last year, when Russia invaded Ukraine, energy prices went up pretty significantly after that. And so, that February to February change didn't really have the impact of the higher energy costs last year as the March to March change did. And so a big part of this drop from 6 to 5% was due to energy prices. So one thing that the Federal Reserve considers is they actually consider it or prioritize it over consumer price index is what's called the core CPI, or core consumer price index, where it takes energy and food changes out. And so that March report earlier this week showed that core CPI for March was actually 5.6%, which is up from 5.5% in February. So when we remove the impact of energy and food changes, we can see that inflation really didn't change a lot or over the past month, as would be indicated if we just looked at that consumer price index. So what this means is basically inflation is still being sticky, even though we are seeing some improvement. The Federal Reserve also uses producer price index and personal consumption expenditure index as measures of inflation that they consider. But again, both of those have been moving lower, but still remain higher than desired levels. I also wanted to mention here that one thing that when we think about what caused this inflation and how do we get to this point, we had a lot of dynamics happening. We had, coming out of COVID, a lot of pent-up consumer demand and high levels of savings from during that time that people were ready to spend. We also still had supply chain disruptions, but also the Federal Reserve, what we think about a lot when we think about what the Federal Reserve can do to influence the economy, we think about interest rates, but the Federal Reserve can also do what's called open market actions or open market operations. And in particular, quantitative easing, which you may have heard, which means that they can increase the money supply. And in this period where we had inflation rapidly growing, the Fed was actually increasing money supply. And so when we look to, what would be in recent, over the past decade, what would be the normal increase in money supply, so to speak, in a 5-year period from 2009 to 14, we saw a 34% increase in money supply. In another 6-year period, almost 40%. But in just over 2 years, the Federal Reserve took action to increase the money supply by 42%, which is pretty notable. So what they were doing is they were doing this in effort to pull us out of that recession that we were in, and it worked, but it basically overshot, and that's why we saw inflation going up in that time. So what's happened since then is that the Federal Reserve has made efforts to pull back and tighten money supply. And we've seen a this is from April 22 to January 23. We saw this decline in money supply, and that decline doesn't seem very significant compared to a 42% increase, but it is significant because if you look back over history at this line, you'll see that it doesn't really go down very often. And this is the most significant decline that we have ever experienced that's happened here over the past year. So anyway, I wanted to just share that. That's something that I feel like we don't see a lot, but I wanted to also note this as we move into interest rates, because the Federal Reserve does have other tools besides interest rates to try to combat inflation. And I wanted to show that they are making efforts here on this end of things as well, and not just on the interest rate side. So moving into interest rates. Shown here are on the vertical axis, this is the cumulative change in interest rates during a rate hike cycle. And the horizontal axis here is the months of the rate hike cycle from the beginning until it ended. And so you can see here that the more steeper curves correspond to the 70s and 80s, whereas the more flatter curves correspond to more recent times. So since the 1990s, the Federal Reserve has mostly taken a slow and steady approach when raising interest rates. But for this 2022-23 cycle that we're currently in, the Fed has been more aggressive, sort of falling between the aggressive hikes of the 70s and 80s and what we've seen more recently. So the Federal Reserve has raised interest rates from over the past year from 0.25% to 4.75%. And actually, if we go back a few months prior, it was actually 0% on the low end of their range. So we've seen that upward movement in interest rates, but what everyone really wants to know is what's ahead. And so most likely the Federal Reserve is going to raise interest rates another 25 basis points. Their notes from the last FOMC meeting indicate another 25 basis point increase is coming, probably at the May or June meeting, although I think all eyes, I don't know, I just saw the other day that I think that the trade estimates are that there's a 70% chance that this will happen at the May meeting as opposed to the June meeting. And then Federal Reserve members' projections indicate that they would hold it constant at that level through the rest of this calendar year. However, some market analysts tend to believe that that'll actually get dropped down sooner than that. But going on what FOMC participants predict, I also wanted to show their range of projections going out over the next year or two. And so you can see here, basically each FOMC member marks where they think that rates should be over the next, how many ever quarters. And so I'm showing here this range that includes the top end and the low end of those projections. So you can kind of see maybe what they're thinking as far as outlook over the next year and into 2025. And, basically the message here is that we're probably going to see a period of holding of interest rates before we see any decline in interest rates. However, depending on how the economy is reacting, again, like I mentioned, in terms of money supply and inflation, the goal is to use these tools to get us to the optimal operation, the optimal functioning of our economy. And you know, sometimes if we overshoot, then we're moving in the opposite direction, like what I showed with money supply. So I think that they're probably going to hold here for a while until they give the economy some time to adjust and see what's needed from there. I just wanted to show, I know when we think about operating, or when we think about interest rates, what's important to our members is, what does this mean for my farm loans? And so, you know, obviously the actual quoted rate on a farm loan is going to depend on, you know, the loan term and the loan amount and other factors, of course, but generally kind of 4% is a gauge for what we could add to the federal funds rate to get maybe an operating loan rate. And so what I did here was show a comparison of, you know, that operating interest rate, operating loan interest rate at a few different points in time, a year ago, and then currently, and then, you know, an in-between point from last fall. And the assumption here, this example looks at the FAPRI estimate for variable cost of production for both 2022 crop and 23 crop was $475 an acre. And so that works out really well for making a comparison like this, because you know, actual variable costs that a farmer might be financing were equal from year to year. So if we assume that the farmer financed that variable cost of production on an operating loan, you know, at the rates a year ago versus the rates today, and then held that loan for a certain term, you can see the added cost. This represents the gray bar to the green bar represents the added cost from that year ago rate to the current rate. And you can see that depending on how long you hold it, if that loan was for, you know, anywhere in the 6 to 12 month range, that just financing the variable cost of production for corn is going to cost the equivalent to about an extra 1 to 2 or more bushels of added expense per acre. Again, depends on the time financed and amounts, and all that will vary, but that's just one example of what this might mean in terms of the farm budget. And I also wanted to talk about exchange rates. And so we don't have time today to show exchange rates for a bunch of different nations, but the nominal broad dollar index is an index that measures the dollar value against major international currencies. And I wanted to point out that it appreciated more than 12% in value in 2022. This was related to interest rate increases. If everything else is constant, an increase in interest rates fuels demand for US dollars, and it causes that real trade weighted exchange rate to rise. And what that means is it takes more units of a foreign currency to purchase US agricultural commodities, which is why exchange rates are important when we think about you know, our exports and ability to trade. I'll also note that the USDA reports what's called the real trade weighted exchange rate by commodity. And for corn, that increased 9.9% from 2021 to 2022. What that means is it took 9.9% more units of a foreign currency on average to purchase US corn. Looking ahead, the outlook for the dollar value really varies among financial analysts. I've seen anywhere from a range of sort of a neutral, no change in dollar value, up to anywhere from 10 to 15% of depreciation in value. And really that's not surprising given what we just talked about with interest rate outlook, because there's varying expectations with that, and that'll have some influence on where dollar value goes. I also want to talk about recession while we're talking about macroeconomy. So there's a number of different indicators for recessions, and several of those are pointing towards like a mild recession later this year. One indicator that's gotten quite a lot of attention recently, given the bank failures, is the relationship between the 2-year and 10-year Treasury note spreads. And so when these spreads are inverted, as you can see it's below that zero line. I should have made that zero line bolder so it was more clear to see there in the middle of the chart. But the inversion of these usually indicates that a recession is coming within 2 years. And so this inversion first happened last year, but notably in early March, it hit that negative 1.07, which was the lowest point going back to the early 1980s. So there we have another comparison to the 1980s, sort of similar to what happened with inflation last summer. And after the Silicon Valley Bank failure, this inversion has narrowed, but it still is negative and points to recession. I will note that this indicator has accurately predicted the last 8 recessions. So it's definitely something that something to watch as we think about where the economy might be headed here throughout the remainder of this year. Oh, there, I forgot that I had that animation in there. Okay, so I also wanted to quickly touch on crude oil prices. So OPEC Plus announced oil production cuts earlier this month, and prices jumped on that announcement. But the good news is that they've really stayed relatively flat between $80 and $85 a barrel after that initial jump up. And it's also important to note that oil prices had actually been trending upwards a little bit before that announcement was made. But like I said, important or good to see that those have remained pretty neutral since then, because if we would see those oil prices continue to grow, that would definitely counter the improving inflation that we're seeing, and you know, maybe change some of the economic outlook there. Going along with this, the Energy and Information Administration reported gasoline prices increased in the 2-week period from March 27th to April 10th, which is likely somewhat tied to this crude oil. So that'll also be something to watch, as gasoline prices are a component of that consumer price index that we talked about. Looking at fertilizer price trends, we hit record highs in 2022 for basically all of our nitrogen fertilizers. I have here anhydrous ammonia, 28%, and urea. All 3 of those nitrogen fertilizer products hit high points, record highs in 2022. Our phosphorus and potash did not hit record highs, but did come fairly close to that. As we look at where we're at on prices right now, we've seen those prices come down, but they still remain pretty high compared to where we were in fall 2020 and compared to a 2009 to 2020 average. So there in the right-hand bar, I'm not going to talk through all of those, but I've included there, where we're at relative, where current prices at relative to both fall 2020 prices and the 2009 to 2020 average. Again, we're still elevated from those points. And so this is definitely still a concern for farmers. I think farmers are appreciative of the relief in fertilizer prices, but again, fertilizer prices remain relatively high. So I'm not going to, in the interest of time for today, I'm not going to talk through these international dynamics in great detail. The report that I'll be sharing has a paragraph related to each of these and sort of a key takeaway point, which is sort of the format of the whole report, as you will see. We've already also talked about a few of these things, specifically the Chinese corn demand and Brazil corn exports already. The Mexico GMO ban is certainly concerning for our industry, and something that we are hoping reaches a resolution soon. The war in Ukraine has kind of taken an interesting twist in terms of what it means for corn and other grains. So I will touch on, Ukraine is prior to the war was, a major corn producer and exporter, and wheat as well. And with after the war in last summer, Russia brokered a deal with the United Nations to allow for grain exports from those Ukrainian ports. And that deal has been renewed a couple times, but comes up for expiration in late May. And Russia has really indicated over the past couple weeks that it may not be very likely that that gets extended again, which is critical because Ukraine's wheat harvest, will start. Their season is similar to ours here in the United States for winter wheat, coming with harvest in early summer, and so that is important if that doesn't get renewed. Actually, there was one day earlier this week where Ukrainian grain exports were halted. I should say exports from their ports were halted for one day, and then it seems like Russia then allowed that to continue. But that'll definitely be a dynamic to watch, and if that deal is not able to be renewed, will definitely be a influence on what happens with grain movement and trade flows globally as we look ahead. Just wanted to talk about a few farm factors here before we wrap up. Planting progress is underway across a lot of the corn belt. I know there's still some areas that have some snow cover, but from what I can tell, it seems like those areas are also having warmer than normal temperatures, and some of that snow is quickly melting off. So we have 7 states that were registering planting progress as of the report on Monday. So far, planting progress is at 3% compared to 2% last year and 5-year average. So that is progressing well. The forecast for this current week that we are in and next week looks good for a lot of the Midwest. So I'm assuming that in the next week or so, if that forecast continues to hold, we'll see a jump in planting. I know corn planters have definitely, or I shouldn't say corn, but corn and beans have been rolling in my area. So I expect to see that continue to grow. I guess I also wanted to talk about, I'm definitely not a weather expert, but as I've been reading a lot, it seems like we are having atmospheric conditions that are moving towards the El Nino pattern. And this is coming away from the La Nina pattern that we've had over the past few years. I think it was sort of expected that this year might be in that neutral phase, but atmospheric conditions are moving maybe a little faster than expected toward the El Nino pattern. I pulled this chart from a Farm Doc article that I thought was really interesting, looking at corn yields in the United States and El Nino and La Nina episodes. And since 1992, above trend yields have happened in more than 60% of El Nino years. And notably, the El Nino years are the red dots here. Notably, when El Nino years are below trend, they are within 1 standard deviation of the trend. Historically. And the other thing of note here is that all 4 years with greater than 1 standard deviation above trend yield were all El Nino years. So I was a little bit uncertain if I agreed with the USDA's yield projection of 181.5. I thought maybe that was a little bit strong. That is above a linear trend line. What a linear trend line would come in at closer to 181, which, like I mentioned earlier, is where FAPRI has yield projected. But after seeing this, I will say that it seems like atmospheric conditions are setting the stage for a strong yield year. Obviously, we still have a lot of planting and growing season left to be making those kinds of statements, but I do think that based on what this shows, that if there's going to be a year where we hit that high yield point, it seems like we're in a good place in terms of planting outlook so far, and maybe what atmospheric conditions might give us for the growing season. I wanted to show U.S. acreage projections here. So for corn, soybeans, wheat, and cotton, I'm showing the actual acreages from the last several years, along with, again, these three projections, sort of similar to what I did on those balance sheet tables earlier. The USDA's Ag Outlook projection first, planting intentions second, of those shaded bars, and then FAPRI's projections third. And overall, what we're seeing is the expected increase in corn acres, soybean acres to stay relatively the same, increase in wheat acres, and cotton acres to be lower. And there's a lot of consistency really among those 3 projections as we look at what might be expected in terms of acres. And when we get through planting season and see where planted acres come in, it'll be interesting to see where those fall. Right now, I guess going back to that, right now it seems like given the way that planting is progressing, a little early to make a lot of judgments on this, but it seems like we may not see as much deviation from planting intentions, because if conditions are fit, farmers are going to plant probably what they intended, as opposed to having those situations where weather dictates otherwise. Looking ahead to U.S. farm income projections, I wanted to use FAPRI this quarter because those projections are relatively new. So this looks at what came out of FAPRI a few weeks ago for net farm income. Projections show, whether we're looking at nominal or real dollars, farm income's lower this year, but higher than 17 to 21 year average. Crop and livestock sector receipts lower than last year, but also above that 2017 to 21 average. And then production expenses to be similar to 2022, a little bit higher. It's going to make a big difference on individual farmers when they bought their fertilizer, where production expenses fall in both 2022 and 23. I wanted to look at U.S. corn cost and returns, and this is my last slide here. And so if you have some questions and want to go ahead and think about those while I wrap up here. And shoot, I just realized that the byline here is copied from another slide, so I will update that before I share these slides. But anyway, what I wanted to show here is FAPRI is projecting variable costs. I mentioned this earlier at $475 for both 22 and 23's crops. Unfortunately, FAPRI doesn't post overhead and land costs by crop. So I pulled those from USDA. I use the FAPRI variable cost as opposed to USDA for all for a couple of reasons. For one, they are more current, and for secondly here, they also, I like the way that they do their modeling to make those projections a little bit better than the way that USDA does. So anyway, but pulling in those together and comparing where 2022 costs are compared to 23 costs, and then also looking at corn revenue. So we don't see a whole lot of difference on the cost side of the equation, really from 22 to 23. Again, this is on average. Individual farms may vary significantly, but the big difference here is on the lower expectation for revenue. Even with that higher yield, the lower price expectation pushes revenue quite a bit lower for 23, which means those margins are going to be quite a bit tighter. We look at average net returns per acre for corn in 22, that comes out to $272 using these figures. And for 23, that's only $77 per acre. Notably, land costs can vary significantly, across regions and owned land versus rented land. And so I just did a break-even land cost for corn production for both years as well. And so that would be $437 in 2022 and only $243 in 2023. I know this doesn't apply in all regions of the United States to the same way it does in Illinois, but in Illinois, where there's a high percent of cash rented land, and that's something that is important to me and on our farm, looking at those difference in values and thinking about where cash rents fall, that's a critical piece of information to consider. So anyway, that's where I plan to wrap up. Again, I will send out the report in this slide set, and I'm happy to answer some questions if anyone has those. Okay, so one question that we have here is how much of the weakness in corn exports is driven by the strength of the dollar or attributable to other factors? I think that it's both of those things. As I showed, I think the strength of the dollar is definitely, it definitely made U.S. corn more expensive in 2022 in particular, and so that certainly was likely to have an effect. But like I mentioned, we also had Brazil continuously growing as an export competitor, and really just a lot of shifts in trade flows happening in 2022, given the war, and China's always kind of a sporadic buyer. So, I mean, I think that the strength of the dollar is definitely a factor, but other factors are playing into that as well.
Krista, I've got Alex has his hand raised. I want to allow him to talk.
Okay.
Alex, go ahead.
Hi, Krista. Thank you very much. I think that what you shared was excellent, and it fits right in line with what I hear a lot from chemical companies that are trying to shift to using corn as a feedstock or using corn-based ethanol as a feedstock. They really want to know, is there going to be corn demand? Is there going to be, what kind of sustainability does corn have versus like sugarcane ethanol and everything? And I think that this would be a great membership plug for some of those companies to become Corn Growers Association members. And so I wondered, first, is this sort of a webinar and things that you're doing, is this something that you're doing just for members, or is it just directed to farmers? And then I wanted to comment on my original question about the corn supply demand graph after you answer that question.
Okay. Yeah. So, well, this is kind of the first go at it. And so for this time, when I sent out the invitations, I sent those to state and national staff, national board. And I also let the state boards know that, or the state staff know that if they wanted to invite their state boards. I know I've heard from a few states that would like this to be open to their membership. So that's definitely something that we can consider for, future webinars. For this one, I kind of wanted to see how it went and get some feedback on the report and the webinar. So I appreciate your feedback on that. And yeah, we can look for ways to use this information to add value and in other ways as well.
Great. And then my comment about the U.S. corn supply and demand graph, we use something, I think it's the exact same graph. We use the ERS data, which I think might have been the one you used, but we actually split out ethanol fuel from food and feed and everything. And I really suggest maybe you do that as well, because otherwise, like you said, ethanol for fuel is 75%. And it looks like we have a lot of corn going to food, which of course we're moving away from in our talking points. And so if you can separate ethanol fuel, and then what we also do is, of course, a third of that corn comes back as feed. And so we put in high protein feed on our graph, which further amplifies that feed is our number one customer. And I really like, companies have really liked that talking point to show that there's really not that much food that field corn goes to, and that we still have a lot of excess and a lot of space to feed their demand for chemicals.
Okay, well, thanks for that. Thanks for that suggestion. I will work on making that change. Are there any other questions?
Just a reminder, if you click that little raised hand icon at the bottom of your screen, that'll I can allow you to talk if you got a question. Right now, I'm not seeing any, Krista.
Okay, and let me bump ahead. I realized I did never flip it to the next slide here, but there's my email if anyone has any questions or feedback or suggest, like Alex's suggestion for improvement on a visual or something that would make it more valuable or helpful to understanding. I appreciate any of that kind of feedback or other questions. So there's my email if you want to reach out